Welcome to Market Brief After Hours. It has been an absolutely wild ride today. On one hand, we saw a massive, eye-popping rally on Wall Street, with the Dow surging over 900 points. On the other hand, we received some incredibly hot inflation data that suggests underlying economic pressures are far from over. Let's break down these conflicting signals. What exactly triggered this massive turnaround in market sentiment today?
It really all came down to a dramatic geopolitical pivot. Earlier in the day, markets were incredibly tense after President Trump posted that the U.S. would be attacking Iran very hard tonight, even mentioning taking control of their oil and gas infrastructure. But then, in a complete reversal, he announced he had canceled the scheduled strikes and that the U.S. is on the verge of signing a deal to ensure Iran never gets a nuclear weapon. That triggered a massive relief rally. The Dow Jones Industrial Average surged 930 points, or 1.86%, to close at 50,849. The S&P 500 gained 1.75%, finishing at 7,394, while the Nasdaq Composite jumped 2.54% to settle at 25,810.
Those are massive gains, especially for a single session. But while the headline numbers look fantastic, we should probably inject a dose of caution here. Is it too early to celebrate the end of this conflict?
Absolutely. It is far too early to assume this is a done deal. While the president mentioned that the documents are in pretty final shape and a signing could happen soon in Europe, he also made it clear that the naval blockade against Iran will remain in full force and effect until the transaction is finalized. So the military pressure hasn't completely vanished. The situation remains highly volatile, and any hitch in the negotiations could easily send markets sliding right back down.
And we saw an immediate reaction in the energy markets, didn't we?
We did. Crude oil prices tumbled as the immediate threat of a wider war seemed to recede. West Texas Intermediate crude fell 2.58% to settle at $87.71 a barrel, and Brent crude dropped 2.92% to end at $90.38. In post-settle trading, those losses actually widened to around 4%. This drop in oil is a relief for consumers, but it highlights just how sensitive energy markets are to every single tweet and press conference right now.
While everyone was watching the geopolitical drama play out, we also got a very significant and frankly concerning economic report on the domestic front. The wholesale inflation numbers came in much hotter than expected. How bad was it?
It was a reality check, to say the least. The Producer Price Index, or PPI, which measures final demand costs for producers, jumped 1.1% in May. Economists were only expecting a 0.7% increase. This pushed the 12-month wholesale inflation rate to a staggering 6.5%, the highest we've seen since November 2022.
That is a massive jump. What was driving that spike?
It was almost entirely driven by energy. Nearly 80% of the acceleration in the TPI came from a 2.8% surge in final demand goods, and 80% of that rise was due to a massive 10.7% jump in wholesale energy costs. In fact, wholesale gasoline prices skyrocketed by 23.4% in May. The silver lining, if you can call it that, is that core PPI, which strips out volatile food and energy, rose 0.4%, which was actually slightly below the 0.5% forecast. So the underlying inflation outside of fuel isn't runaway, but these massive energy costs are still a heavy burden on the pipeline.
And what about the labor market? We also saw some new jobless claims data today.
Yes, initial jobless claims rose by 4,000 to a three-month high of 229,000 for the week ending June 6th. That was higher than the 219,000 economists expected. Continuing claims also crept up to 1,795,000. Now, some of this might be due to early summer seasonal factors like non-teaching school staff filing for benefits, which the government's models don't always perfectly adjust for. But overall, it shows a labor market that is still resilient, even if we are starting to see some very minor cracks.
It's a fascinating dynamic. On one hand, hot wholesale inflation, and on the other, a slight rise in jobless claims and falling oil prices. How did the bond market digest all of this?
Treasury yields actually tumbled, choosing to focus more on the falling oil prices and the canceled military strikes than the hot PPI print. The yield on the benchmark 10-year Treasury note fell over 8 basis points to 4.453%. The policy-sensitive 2-year Treasury yield slipped to 4.054%, and the 30-year yield fell to 4.95%. Bond traders clearly breathed a sigh of relief that a major military escalation in the Middle East appears to have been avoided for now.
Let's take a quick pause here. When we return, we'll look at how international markets responded to these developments, dive into the latest Forex movements, and highlight the individual stock movers of the day. Stay with us. Welcome back to Market Brief, After Hours. Before the break, we focused on the dramatic events in the U.S. Let's expand our view globally. European markets closed broadly higher today, but they had their own major news to deal with, specifically from the European Central Bank. What happened there?
The European Central Bank made a major move, raising interest rates by 25 basis points at its June 2026 meeting. This is their first rate hike since 2023. Policymakers explicitly pointed to rising energy costs and persistent inflation risks stemming from the Middle East conflict and shipping disruptions in the Strait of Hormuz. They actually revised their inflation forecasts upward, now expecting headline inflation to hit 3.0% in 2026 and 2.3% in 2027. At the same time, they slightly trimmed their Eurozone GDP growth projections to 0.8% for 2026. So Europe is dealing with a very real stagflationary threat.
And how did individual European indexes perform under that pressure?
Despite the rate hike, the overall market tone was positive. The Pan-European Stoxx 600 rose 0.54%. In the UK, the FTSE 100 gained 0.48%, matching France's CAC 40. Germany's DAX edged up a minor 0.06%, while Switzerland's SMI finished 0.49% higher. Italy's FTSE MIB was the standout, jumping nearly 1% or 476 points. We also saw some stabilization signs in the UK property market, even though the RICS house price balance remained negative at minus 35%. Meanwhile, Irish annual inflation ticked down slightly to 3.6%, and Sweden's headline consumer prices rose 1.5% year-on-year.
What about Asian markets? Did they catch the same positive wave?
Asia was much more mixed and cautious. China's Shanghai Composite slipped 0.16% to 3,987, largely because big tech names like Alibaba and JD.com dragged down the index due to ongoing regulatory scrutiny concerns. Hong Kong's Hang Seng also fell 0.65%. In Japan, markets fluctuated and ended flat. The Nikkei was up marginally to 64,217, but a government survey showed business sentiment among major Japanese firms actually worsened in the second quarter.
Was there any bright spot in Asia?
South Korea was a notable exception. The Kospi rose 0.43% to 7,763, boosted by incredible government data showing that South Korea's chip exports more than tripled in the first 10 days of June compared to last year, reaching $11 billion. That sent chip makers like SK Hynix up 2.6%. Australia, however, ended slightly lower, with the S&P ASX 200 dropping 0.23% as property tax fears hit bank stocks.
Let's pin a tin of foreign exchange and currency markets, which saw some very sharp technical moves today. Let's start with the euro.
The Euro-USD pair staged a decent rebound, closing up 0.38% at 1.1579, trading near its session highs. However, from a technical standpoint, the pair is still in a very tough spot. It is trading well below its key moving averages. The 50-day simple moving average is at 1.1670, the 100-day is at 1.1690, and the 200-day is at 1.1677. While we saw a nice intraday reversal today, the broader structure is still quite bearish unless it can break above failed support around 1.1620.
And what about the British pound?
Similar story. GBP USD closed up 0.37% at 1.3417, interacting directly with its crucial 200-day moving average of 1.3419. It remains below its 50-day SMA of 1.3464 and 100-day SMA of 1.3474. Buyers successfully defended the 1.3325 level today, but the medium-term trend is still characterized by lower highs.
The Japanese yen and Swiss franc also had some notable pullbacks against the dollar.
Yes, the dollar-yen pair retreated from its recent highs, closing down 0.47% at 159.78. It had briefly poked above 160.5 before sellers stepped in. It is still in a very strong uptrend, trading comfortably above its 50-day moving average of 158.93 and its 200-day at 155.61. As for the Swiss franc, USD CHF fell 0.62% to close at 0.7950, rejecting the psychological 0.8000 level. It is still holding above its 200-day moving average of 0.7903, so the medium-term bullish breakout is still technically alive.
We also have to talk about precious metals. Gold and silver had absolutely massive days.
Massive is the right word. Gold surged 3.48% to close at $4,212 an ounce, completely wiping out the previous day's losses. It is still technically below its 200-day moving average of $4,419 and its 50-day at $4,600. But today's dramatic rejection of the $4,024 level looks like a classic capitulation bounce. Silver was even more explosive, skyrocketing 6.36% to close exactly on its 200-day moving average at $67.40. It was a violent short-covering rally that caught many sellers completely off guard.
Let's wrap up with the individual equity movers. Tech, and specifically semiconductors, seem to lead the charge today in the U.S.
Yes, the chip sector had a massive relief rally. The iShares Semiconductor ETF, the SOX, gained more than 8%. This comes after a brutal 10% drop last Friday had investors wondering if the AI-driven chip boom was over. Intel was a huge contributor, jumping 9% after Bank of America upgraded the stock to a buy. SanDisk also led the S&P 500 and Nasdaq 100, closing up more than 14%.
Who else stood out today?
Voyager Technologies jumped over 16% after BTIG started coverage with a buy rating and a $55 price target. Novin rose over 9% after raising its full-year revenue outlook well above consensus. We also saw crypto-exposed stocks rally as Bitcoin gained over 3%. Galaxy Digital rose 10%, Riot Platforms gained 8%, and Coinbase was up over 4%.
But it wasn't a green day for all of tech. Who missed out on the party?
Oracle was a major casualty, dropping 8% after the software giant announced plans to raise an additional $20 billion in equity and debt to fund its artificial intelligence infrastructure expansion. Investors clearly didn't love the dilution and debt load. Autodesk also dropped over 7%, and Adobe fell more than 6%, hitting a fresh 52-week low. So even in a massive upmarket, investors are punishing companies with high capital demands or weak outlooks.
And that wraps up today's episode. If you find this useful, please follow Market Brief After Hours on your favorite podcast platform.